Hey folks, welcome to Market Technical Analysis for Thursday, February 21st, 2008. Well, as we get started into today's market activity, we're going to just touch briefly on what happened today across the board, look at the intraday stock channels and charts, and then focus on the overall view of the market on the daily. What I want to get right into first is taking a look at the intraday ES, and again we use the 10-minute on the ES futures, which is the March '08 E-mini contract. What you guys can see today is we gapped up, and we ever since early pre-market we were gapping up, and some jobs data coming out early this morning actually continued to help that market, but it was of a non-event in the long run as we sold off pretty quickly as the market began its open at 9:30. That was pretty much the top. We topped out right around 10 o'clock, which is a key reversal time for those of you that know the key reversal times, and you can see the sell-off that ensued. Right here we're looking at the 10 o'clock high, and you can see that little bit of a tail formation. We've been hugging the 20 moving average the whole time right there, and all of a sudden you see a breakdown. Really don't stop at the 50. You kind of consolidate right on the 50 for a candle or two, continue to sell off right down to the 200 intraday moving average, at which point you continue to bounce off that moving average. And again, we always stress that the first hit of these moving averages, especially the 200, is always a bounce play or candidate. Alright, after we bounced off that, we almost came right into the 20 moving average, as you can see here on the chart, and then continued our downward move with small bounces along the way. Right around 2:30, we started to get a little bit of a solid bounce, the first real solid bounce since about 11 o'clock in the morning, and you can see we moved right into that 20 moving average again, which was good resistance, and it caused another sell-off, and we continued down all the way down here, at which point we found a little bit of a bottom in the market. And you can see the tails were below that. We had other bars on the 10-minute here sell off below that line, but it never closed down there. Continued to build a base there, and finally went up a little bit into the close, right back to that 20 moving average. So you can see all day that 20 moving average was extremely important, even up here when we hugged it along the gap up with that point in the markets. And ever since then, we just kind of sold off. And you can draw a trend line. Look at trend line here. Look at this trend line. From the top here, right down. Everywhere you go, there's the top right there touching that trend line. Again, right here touching the trend line, and all the way into the close. So that line was significant all day. And you can follow that line even, at a point tomorrow. It may become important for a bottom in the market or a top in the market at some point tomorrow. So keep that in mind, and you can continue that line all the way to tomorrow's chart. Now, the keys here, and I'm going to focus in on this, and let's take a couple of these lines away as we were drawing them in. But we want to look at an expanded chart now of the 120-minute or 120 time frame chart. And we'll do that by just changing our setup here to 120. And that's going to give us a better view of a longer time period, so we can kind of focus in. Alright, so each candle represents 120 minutes, and this is an intraday 120-minute chart here. So what you see here is the dramatic sell-off after the gap up, but why I wanted to show this chart today is because you can see a key M pattern formation here. Look at that M. Okay. Alright, so that's something we need to watch. And I love the double top right up here. Look at that double top there. And in addition, you have the lows here as a base. So we had a low here, moved up, moved down to the lows again. We pierced it, but we never closed below, at which point we moved up to a double top. And then again back today, and the low of the day pierced that line again, but we didn't close below. So you have two key areas of support and resistance here. Here's our support, and here's our resistance. And again, this is the 120-minute chart, and we're going back as long as till the 17th here, and the 16th is back here. All right. So just keep an eye on that and keep it in perspective there. Now let's take a look at the SPY. Now, we're going to switch to the daily on the SPY and focus more in on the daily here. And you can see that triangle we've been focusing on for so many days now, and it's continuing to stay intact. This market has virtually remained in a sideways trading pattern ever since the January lows, where we sold off down 500 on the Dow 2 days in a row and rallied each day to come to the positive side. Alright, so again, take a look at the triangle formation here, and you can see we're coming right to a head. And we'll draw that in a little better. And there we go. And you can see, still staying in that sideways channel. And I want to just draw this line in again, as I always like to do. You can see this is the pattern we've been in. You've been up above it, below it, above it, below it. But virtually, you take all the averages, you're going to get a straight line straight across, as I've drawn in. Now the key level to watch on this chart is going to be the the February 7th low. Should we break that February 7th low, we are going to retest most likely the lows from January. So we'll draw that low from January in, and we'll draw the February low, February 7th low in as well. So this is a key line of support. Should we break out of this channel to the downside, the next area of support will be this. That's the February 7th low on the SPY, and that's approximately at 132-ish, give or take. And once you break through that, the next spot of support is going to be the lows from January, and that could get very, very ugly should we retest those lows. All right. On the upside, you're looking for a breakout of the channel, so somewhere in this range. And if we do break out, I suspect we will trade all the way up to this 50 moving average, which also coincides with the high here on, that would be February 1st. All right. So there's two areas to watch, and again, just focus in on that triangle. Now looking at the NASDAQ, you're going to see the basic triangle, but the NASDAQ's been weaker overall, and you can see it's a much more flat-bottomed chart here. And I have drawn the lower end of that triangle in already. You can even draw the upper part of the triangle in right here. And you can still see we're focused in between that. And you can see the choppiness of this market. Again, we've gone up, we've gone down, we've gone up, we've gone down. Each move is getting smaller and smaller, though. So eventually we will break one way, and it could be a dramatic move each way. On the downside, continue to follow that February 7th low on the NASDAQ there. And on the high side, on a breakout of that triangle, follow the February 1st high. Okay? So continue to focus in on that. And as we go into more detail here on some other charts, which we will go into, let's take a look at the QQQ. And again, you can see the choppiness of the QQQ, virtually trading sideways. We're just hugging that 20 moving average all the way down. And again, you can draw the triangle from the lower side of things, and there you go. So this appears on all charts, all time frames, and it's going to be key which way we break. It's going to be a pretty dramatic move. Now let's focus in on a few other stocks here, and I want to just touch on these stocks because we've been seeing relative weakness in this market. Number one is Google. All right, notice how the market in the SPY and the NASDAQ has come off the lows, and it's kind of trading in this sideways pattern. Well, Google has reversed this pattern. It was trading in a beautiful little up channel, but this is a bearish chart pattern right here. Notice how it came right into the 20 moving average and is now selling off and looking like it's going back to the lows. At this point, Google has virtually taken out the low end of any support here and should head back to the lows. All right. Now the question still remains whether or not we have a rally in this market. Or one more push up before the next shoe drops. We do suspect a new shoe to drop, but we may see one more push up before that. All right, that shoe to drop could be anything. It could be something with a financial firm. It could be someone going under. It could be a major warning out there. There's a gambit of possibilities about what this could be. In addition, Baidu is following Google right down as well. Baidu's been weak. They're virtually the same stock. They trade almost identically, and you can see the relative weakness in that chart as well. Well off the highs here. Baidu was over $400 at the end of 2007, now trading at $240 and change. And Research in Motion is one I want to touch on today. Research in Motion had a nice gap up in the chart, and we saw it closing up about almost $9 on the day after reporting that their subscriber rate or some nonsense like that was up substantially. And in any case, in a very weak market today that reversed pretty ugly to the downside, we did see some positive movements on Research in Motion today. The question will be, does it fill that gap at some point on the next leg down? My suspicions would be it does when we do take the next tumble in this market. So watch for that. Should we break the gap window to the downside, meaning should we trade a candle in this area right below that low from today, you may see it continue to sell all the way off, closing that gap, which would be right around that 50 moving average. Alright folks, as we finish up this video today, and then finishing up talking about Research in Motion here, there's not a lot to say today. It was a relatively light volume day on the downside. We saw a decent volume day yesterday to the upside, and a lighter volume sell-off today. The sell-off, however, did come after a gap up, and we've been seeing that a lot lately. We've been seeing gap ups fail. Almost every day we gap up, we always end the market negative. And vice versa. Any gap down, it seems to rally the markets, and now it takes it positive. Yesterday was a prime example of that. So we're seeing sentiment. It seems like everything goes the opposite way. If the market's gapping down, there's too many bears in the market, and they have to take that money from the bears and push it up. And in the opposite view, If there's a gap up, everyone gets excited, goes long, and they have to take the money from them and push the market to the negative side. So use that in your trading, all right? There's nothing that says you can't use sentiment. You guys know we believe purely in psychology, technicals, all right? This is the key to trading. You have to trade people. You're not trading stocks, you're trading people and sentiment. All right, so follow those technicals. They tell you all that psychology stuff. Follow the general trend of the markets, and generally, if there's a strong trend one way or the other, the markets will reverse that trend if enough people are skittish on the downside or bullish on the upside. All right, that's about it. We just saw a continued dribble down effect today in a slow market today, and we will see what tomorrow brings. Tomorrow being Friday. Have a wonderful evening, guys. Come join the swing trade alerts, the options alerts, the ETF alerts, and the chat room. It's a good time and good money to be made out there without a doubt, even in this bearish market. Take care. Talk to you soon.